All right, so for everyone who's joined in so far, thanks so much for joining. We're really excited to be co-hosting this webinar with Fortress, and Chris Gear, who we've gotten to know over the past few months, is fantastic. So really excited to have him on. We'll let him introduce himself, but just really quickly, a quick disclaimer that we wanted to start off with. So the commentary in the webinar is for a general audience only and does not constitute a specific investment advice or represent an endorsement of OneFund or Fortress of each other. OneFund and Fortress Financial Partners are separate entities. So once again, everyone, thanks so much for joining. My name is John Bailey. I'm the co-founder of OneFund Investments, along with my friend and coworker, Spencer Moslow. And we're very excited to have Chris here. Chris, do you want to give a quick intro of yourself?
Yeah, John, thanks so much for inviting me to be on. Shout out to Spencer as well. Excited to go through some of the underrepresented tax benefits of investing in venture and private equity.
Awesome. So yeah, I'll share my screen and we can get this kicked off. But what we're really excited to talk about today, the topic of the webinar is called Uncommon Returns, a look at private equity. And really what we're excited to be talking about today is just kind of a very general overview on what is private equity to start things off, but then a deep dive into why people tend to invest in it, some of its pros and cons. And then Chris obviously deep diving into some of the really cool tax advantages that come out of private equity and venture capital, or can come out of private equity and venture capital. And feel free at any time to throw any questions you might have into the Q&A. We'll save some time for that at the end. So I think just very broadly starting off with, the big reason why we started OneFund was because we felt like private equity is this amazing asset class, and people really haven't known about it on Main Street. On Wall Street, yes, but on Main Street, it hasn't been, there's just not as much education around it, not as much awareness, and also not as much access. So we wanted to kind of kick off the webinar by chatting a little bit about the difference between public markets and private markets. So on the public market side, you can think like the New York Stock Exchange, NASDAQ, where a lot of those publicly traded securities are that a lot of us probably hold in our brokerage accounts or retirement accounts, et cetera. And then on the private market side, you have companies that, for lack of a better term, aren't public. They're often owned by families. Any family business is a private market company. They might be kind of closely held entities by the two co-founders who have started the business. Often they can be a lot smaller businesses, but they can also be really huge, multi-billion-dollar organizations. If you're familiar with Stripe or OpenAI, the careers of ChatGPT, those are examples of really, really huge private companies. And the majority of the US economy actually sits in the private markets, which I find really interesting. I'm a huge diversification guy when it comes to my own investment holdings. And so a big part of the genesis or reason for why we started OneFund was about how do we get more people to have access to those private markets, because they do constitute so much of the economy. And no matter how diversified you are in public markets, you never have that sliver of the private markets. And so whereas, public markets, you can access them through the New York Stock Exchange or through NASDAQ, for two examples, the way you access private markets is totally different. It's completely distributed amongst either people investing directly into startups, doing like angel investments, which can be quite nice if you know what you're doing, but also quite risky. Or it often involves going to private equity funds, companies who limited partners or investors give money to, and then they'll go out and find some of those private companies that I mentioned earlier, and they, professionally will make investments in them. One thing that's super different about private equity and public markets is in public markets, you have total liquidity, right? At any time you can sell your investment. Private markets are less liquid. And we'll get a little bit into the pros and cons of that later on in terms of what that looks like from a returns perspective and also from a cash flow perspective. Historically, actually, private equity has outperformed public markets. There's data from Cambridge Associates that shows that between 4 to 5 percentage points improvement over public markets in terms of what is in, say, a private market index. So typically your average private equity fund outperforms the public markets. But that being said, not every private equity fund is your average private equity fund, right? Some are really fantastic and super strong, and others not as much. And so we can dive a little bit later on into how manager selection works and what that dispersion actually looks like. But in terms of what we're talking about when we talk about private equity funds and venture cap, or when we talk about private equity, there's actually three main buckets. A lot of times when people think about private equity, they think about kind of, the household names in the private equity space. So KKR, Warburg, Blackstone, et cetera. And those are actually private equity funds that are more characterized as buyout. But there's also venture capital and growth equity. And some of the big differences between these three different types is the phase of the companies that they invest in. So if you invest in a venture capital fund, that's still private equity, but venture capital funds, firms like Andreessen Horowitz, for example, they are investing in much smaller companies, companies that are new, companies that are attempting to scale, and they'll typically write relatively small investments into those companies compared to what a buyout private equity fund might do. And part of that is because of the risk that they're taking on. Venture capital firms are investing in much younger companies that haven't necessarily proved themselves, but that means there's the potential for really great return as well as really great downside. So they'll often spread out that risk by placing a ton of different bets on a ton of different companies. So a venture capital fund, for example, may have investments in 100 plus companies, whereas a buyout private equity fund might have investments in 10 or 15 companies. So a really, really different philosophy there. So buyout companies are investing in much later stage organizations. They're probably not growing as quickly. They could even be doing a take private. So taking a company that's on the stock exchange that they think there's some dislocation in terms of the value and actually bringing it private, buying all of the shares and trying to operate and then sell it down the line. So if on the far left, we have venture capital making super early stage bets. And on the far right, we have buyout kind of employing a lot of leverage, buying very large companies. In the middle, we have this interesting sliver called growth equity. Before starting OneFund, I actually worked at one of these funds, General Atlantic, for a few years. And what growth equity funds end up doing is they take investments in companies that are kind of past the venture capital stage. So they're not super young companies anymore. They're less risky in that they found some product market fit. They're probably making sales, but they're too young for buyout to be interested. They're still growing too quickly. They're not really on, they're still growing. They're not really on the verge of reaching maturity, as one might call it. And a growth equity fund will go in and give them growth or expansion capital to really help them double down on the strategy that's been helping them to grow so far. So when we talk about private equity, this is the total landscape of the different types of companies that fall under that umbrella. And myself personally, being a big fan of diversification, I place investments across all three of these buckets. But I think it's up to sort of an individual as they're thinking through, okay, what do I want my personal portfolio to look like? And that's also a great conversation to have with, your financial consultant or advisor or accountant. Chris, I don't know if you have any thoughts on sort of the risk return profile of different buckets of private equity, and maybe not how people should be allocating between them, but how people might think about allocating between venture, growth, and buyout.
Yeah, I don't want to steal the thunder from that awesome chart you have, but there's really only a few levers you can pull to increase the returns you're getting. And when you dial it down, it's, do you want to go earlier stage to smaller companies? So on the public side, that's small caps, or when it comes to the private side, that'd be early venture capital. And then the alternative is, and really the whole theme of today, is private markets. So in public markets, everything is disclosed. They are operating their business to hit their next quarter numbers. In private markets, those rules go out the window. They can do whatever they need to do to grow the business.
And one thing that I definitely saw time and time again while working in private markets was just the having an entire team focused on how to grow the company, and a relatively tight group of shareholders makes it a lot, you have a lot fewer distractions. You're not planning on a quarter by quarter basis the way public companies might be. You're thinking a little bit more long term, a few years in advance, which kind of sounds shocking. We don't often think of that as long term, but when you're a public company, you have so many shareholders. You really are thinking, you're barely looking in front of your face, kind of thinking about what the next quarter looks like. And here's some great data from McKinsey that shows, across those three buckets of venture, buyout, and growth, what the returns actually look like. So what this chart is showing is it's showing that dark blue bar is how a 75th percentile fund performs, so kind of the top quarter of funds on a yearly return basis, IRR. That light blue is kind of what your median or typical or average fund might look like, and then that lightest blue is how a bottom 25 percentile fund has performed. And this is data for 10 years from 2009 to 2019. And there are kind of like two key highlights that I think are really interesting from this slide, or three rather. The first is that this is, especially in venture and buyout, if you look at kind of the median funds, it has outperformed the public markets. And there are a couple of reasons for this. It's not like it's a silver bullet and kind of it magically does this. And there's a reason why even the most sophisticated institutional investors don't put all their money into private equity, which we can talk about in a minute. But aside from it being just kind of historically higher returns over that time span, the first thing that is really interesting to me is the dispersion that you're seeing. So among venture capital, the difference between the top quartile and the bottom quartile funds was nearly 22% annual returns. Whereas when you go into buyout and growth, that shrinks significantly to about 12 to 15%. So it's very interesting seeing that dispersion. And the second point that brings up is really the importance of manager selection. When you are going in and buying, stocks on the public stock market, you can buy a S&P 500 or a total stock market index. That doesn't exist in private equity. And so it's really important when you are looking at a fund and thinking about what to invest in, that you're performing your due diligence on that fund. At OneFund, we spent a lot of time doing due diligence on funds. Over the last year, I think I've looked at roughly 100 different private equity funds across these buckets. And we're always making sure to look at how the fund has performed historically. And there's some very interesting data out there on how useful that information actually is. And it's important, but not as useful as you might think. How the individual team members have performed, what the fund's thesis is, who their existing investors are. If a fund has large institutional investors, that can often be a helpful vote of confidence. And so these things are all really important and something that you want to look at. And the more that you're able to look at, the more you can kind of benchmark across funds and get a sense of, okay, what actually kind of looks like a fund that I would be interested in investing in. But I think just the quality of the returns and then also the importance of manager selection is a really interesting takeaway coming out of this slide. And then I share this slide in probably almost every webinar we do because I absolutely love this chart. But what this chart is showing is the risk-adjusted returns of a portfolio of assets, and a portfolio that exists entirely in traditional assets. So think, public equities, government bonds, REITs, et cetera. And then a portfolio that incorporates in alternative assets. So late stage venture capital, buyout, private equity, et cetera. And so the way to think about this is that gray line is kind of your risk-adjusted return of traditional assets. And so what Fidelity did was they looked at data from 2005 to 2021, and they took a look at, okay, if you're going to have X amount of volatility or risk in your portfolio and you're in traditional assets, here's what your return is going to be. But then when Fidelity incorporated in alternative assets to that methodology, they actually saw the risk adjusted return go up, and up to that green line. And it shows you the power of diversification. I mean, we've known this for years in public equity markets, right? That really the only free lunch is diversification. It's the only way to increase your risk adjusted returns. And it's very interesting seeing this chart and seeing that that's also true for, or Fidelity saw in the data that this is also true across this time period for alternative assets, for private equity and venture capital being incorporated in. And that's really the huge genesis. This is the reason why we started OneFund, right? It's to get more people the opportunity to invest in venture capital and private equity, so that more people have the option of trying to get from this gray line to this green line. Chris, I don't know if you have, I mean, you think about asset allocation day in and day out. I don't know if you have any thoughts on this.
Yeah, so I should preface with saying that the investment selection is really only a sliver of what we do with clients. But what's interesting is the best advisor or advisor to client relationships that I've seen grow past that risk tolerance questionnaire. That's if you're going to use the online risk advisor or financial advisor, answer 30 questions, we'll give you a number out of 10 or out of 100, and then that'll be our asset allocation. But if your advisor is able to educate you on what it is the difference between a US large cap growth fund and a private equity growth fund, and that can have a meaningful difference in your portfolio returns over time, that's where the magic is. It's not the risk tolerance, it's the risk capacity. So the risk tolerance is just your willingness to take risk. That's a two-dimensional way of looking at it. Your risk capacity is the amount of money you can put at risk. So we look at clients all the time where they have a large exit, they look at the T-bills paying 5+% in a money market, and they say, I don't need any more money than that. But then you can change the frame of the conversation to say, hey, you can't spend this money in 10 lifetimes. For this to really grow and leave a legacy behind, you can afford to take more risk. And we just wanted to take smart risk with your money instead.
So I really quickly, like, I just wanted to touch on some of the benefits and drawbacks of private equity, because we try to have a pretty even hand here. In terms of the potential benefits, historically, it's been quite high returns compared to public markets. Data from Cambridge Associates, looking at the last 25 years or so, shows that their index of private equity funds has beaten public markets or public market indices by about 4 to 5% per year, and that's really, really, really significant. But also important to keep in mind kind of that chart that I showed earlier that talks about the dispersion across different funds. You can have funds in the bottom 25th percentile and the top 25th percent performing vastly different. The other benefit is just access to private markets in general. Private equity is a really efficient way to make one investment in one private equity fund and then get access to 10, 20, 100 plus different private companies that you otherwise would never be able to have access to. There's also some potential tax benefits that you can get through programs such as QSBS, and Chris will talk about those a bit in a minute. In terms of drawbacks, one of the big things that is important to realize in private equity is the illiquidity of the asset class. Unlike, if you buy a stock of Ford or Facebook or Meta now rather, you can sell that anytime you want and trade in for something else. With a private equity fund, you can't necessarily do that. And that's part of the reason why, if you look at top endowments or institutional investors, they typically put, I want to say, about 15 to 20% of their portfolio into private equity. And from a personal standpoint, that's roughly what Spencer and I track and aim towards as well. But illiquidity has some benefits to it as well. And we won't get like too academic, but illiquidity is actually part of the reason why, from an academic standpoint, private equity funds tend to outperform. There's this concept called the illiquidity premium, which is that if I'm going to make an investment and it's going to be locked up for a certain period of time, I, as an investor, am going to demand excess return for that over the public markets. And so for an academic standpoint, this illiquidity is actually part of the reason why funds can outperform. And this is really important. If you're it's why we always say, you really shouldn't put money into a private equity fund that you're going to need in the next 5 years or so, because you just can't. You're not going to be able to get that. However, if you know you're not going to need a certain amount of money for the next 5 or 10 years, and it's in a liquid asset, you're not getting, or you're not being able to take advantage of this illiquidity premium. So there are some drawbacks to it, but it is also one of the fundamental reasons why private equity on average tends to perform quite well. The other drawback is that it can be difficult to get access to the funds. There's no stock exchange for private equity the way that there is for public equities. And so all these funds are spread out, and they tend to have really high minimums. It can often be like $10 million plus for some top funds. And that's another big part of the reason why we started OneFund, was to make it easier to get access to some of these funds for knowledgeable investors. And then lastly, there's limited control and visibility once an investment is made. Unlike public equities that are regulated and have to put out, a 10K, a 10Q, release their financials every quarter, private companies don't have to follow these rules. And so, you may only get updates on how the portfolio is performing once a year. And so there is a little bit less visibility in terms of once the investment is made. And that's a trade-off that a lot of investors are willing to take for some of the potential benefits. But I think it's really important to kind of think through this stuff holistically when we're thinking about private equity versus public equity versus real estate versus things like that. It's something that I always keep in mind personally when we're deciding, whether or not to make an investment in the private equity space, for example. I think, Chris, I'll hand it over to you. Would love to, hear a bit of how you guys think through some of the tax advantages or potential tax advantages of this stuff. This is my contact information up here. So anyway, please feel free to reach out or email me at any time. But Chris, really excited to hear what you have to say on tax.
Yes, this QSBS tax provision, or Section 1202, this is how you read about people selling their company, making $10 million and not paying any taxes. This is the actual tax filing that's going behind the scenes. And I think it's important to start out with a strong difference between tax preparation, so that's dropping things off at your accountant's office, and tax planning. Tax preparation is you sending that email saying, hey, are my taxes finished yet? Tax planning is everything you do up to that point during the calendar year, most of the time, to make sure that you're going to minimize your lifetime tax bill. QSBS has to be one of the most efficient ways to do that. So we'll go back to a quick history lesson of this, just to show you how slow the IRS moves. This was originally introduced back in the early 90s. When it was first introduced, there was only a 50% exclusion on the capital gains. In the 2009, 10, 11 era, they did look at changing it, and it went up to 50%, as high as 75 and 100. And then only recently being 2015, did they permanently extend the 100% exclusion of QSBS. And that is for shares acquired after 2010, just to make sure that the math works right. So QSBS, the way to do it, you must acquire original issued shares. That means you cannot buy it from someone else in a secondary market. The small business must be a C corporation. So if you understand how C corps work, the drawback is that it's a double taxation. The benefit here is that there will be no capital gains tax if it's QSBS eligible on exit. The company cannot have more than $50 million in aggregate gross assets. So can't be already up and running. The point of QSBS is to invest in entrepreneurship, and you must hold on to the shares for at least 5 years. So back to John's point around that illiquidity premium, this is pretty standard for small companies, not always a big issue. The benefit that people don't understand is that this isn't just for the business owners. For venture capital funds and their LPs, they are eligible for the same tax treatment. So what does that mean for someone's portfolio? If you're in a venture fund and one of the companies grows from $1 million to $11 million when the fund sells it, when the fund receives the $10 million of profits, that is taxed at 0%. When it's distributed to the LPs, they are not taxed on those gains. They receive the QSBS treatment, meaning that the tax equivalent return, the true IRR being what you keep in your pocket, is going to be much higher than a traditional investment. Now, I hope everyone's gears are turning in their head. This always leads to the same exact question. Well, if I have X% of my company in my name, and then put half of it in my wife's name, or part of it in my kids' names, in theory, and I'm not a tax person, not a lawyer or anything like that, but trust stacking is the terminology. And if you put those shares, as long as they check all the boxes, in different names, your estate planner is going to have a heart attack, but you will be able to stack the QSBS benefit.
Do you have any sort of insight on like how do companies qualify for this? Is there anything that companies need to do to make sure that they're in the best position to have, their owners be able to take advantage of QSBS?
Yes, it is shockingly misdiagnosed. So you can read tons of horror stories of early Uber employees who are eligible for all of these benefits, not realizing them. You have to have your CPA fill out the form. I believe it's one, maybe 1 or 2 page that you self fill out. You are responsible for tracking all these dates and submitting it to the IRS. So as long as you have all the paperwork showing that you qualify, original shares, C corporation, less than 50 million in assets, held it for 5 years, you qualify.
One thing that always boggles my mind is how little is kind of known about this honestly really, really huge benefit as a business owner. And so, I learned about a year ago that this can apply towards private equity and venture capital funds, and not just towards the funds themselves, but towards the investors in those funds. So somebody is an LP in a venture capital fund. If that venture capital fund, like Chris said, they are always buying, typically they are buying mostly new issuances of shares. And so they end up qualifying. And that investors in those funds have those benefits passed through to them, because you have to be a person to actually get those benefits. So the fund itself can't. It goes on to its initial investors. But one thing that I found really surprising, and I don't know if you have a take on this, is when we've been diligencing funds, I have never once come across a venture capital fund or a private equity fund that has said, oh, hey, we invest in QSBS qualifying companies. They've never once advertised it. But every time I ask, especially in the venture capital space, and I can discuss why I think that is in a minute, every time I ask, or many of the funds have said, oh, yes, they'll never say how much in their current fund will qualify, because there's no way to know that because of the requirements. But they might say, oh, yeah, in fund 1 and fund 2, our predecessor funds, we had 50 to 75% qualify for QSBS. And it always boggles my mind that they never say that unsolicited, because it's such a huge benefit for LPs. And I don't know if you have any thoughts on why that is. Are people just not aware of it? Is there some sort of rule in terms of how they're allowed to disclose it? It's always sort of shocked me.
Someone will mute me if I give you all my real thoughts, but it's amazing that every realtor in America leads with the tax benefits of real estate. Well, I can tell you that my personal real estate holdings, the tax benefit is they're all losing money. So they don't need any extra tax benefits on this. If you talk to any sort of municipal bond fund manager, they lead with the tax benefits. One of our jobs is to look at the risk-adjusted returns and make sure clients understand that. The next, and maybe even above that, but the most important thing is, what are my true net returns? Everyone knows to talk about the fees. No one thinks to talk about the taxes proactively, that tax planning piece, where it's like, okay, yes, your venture fund could potentially have 25% annualized returns if it's a average or above fund. But what does that equate to if you found another investment without these tax benefits that did the same thing? It's a huge difference to the money that actually goes into your pocket.
At OneFund, when we're diligencing funds, especially with VC funds, we do ask the question about how much of their portfolio, historical portfolio, has qualified or is likely to qualify for QSBS. And you can never make any promises about it, but you at least want to know, okay, the fund is thinking about this and they're looking at this, because it's really, really good for their LPs. And it actually carries little to no benefit for the fund itself, because they can't advertise QSBS write-offs as returns. They can't make a performance-based bonus on it, at least by my understanding. But come tax season, their LPs get a huge benefit. And so it's important to think, are they thinking through this? But the other thing to be aware of is that when you're talking about really, really big funds, this is mostly going to benefit venture capital funds. And the reason for that is what Chris mentioned earlier, is that you have to be under $50 million in assets. Most companies that are being purchased by buyout private equity funds, for example, are beyond this threshold. Whereas most venture capital investments, especially at the pre-seed and seed round, and sometimes even Series A stage, fall below this threshold, and so you can get those benefits. I've seen some growth equity funds have some meaningful portion of their fund be covered under QSBS benefits, but for the most part, these benefits do fall into the venture capital asset class, really having to do with kind of just the size of the company that's being invested in.
Yeah, venture, specifically early stage venture. And to make your job even more difficult, it's generally these smaller funds that are going to realize the largest benefit. I think one of the reasons that fund managers don't like to talk about it is because they want to have more than a 10x return on these early investments. That power law theory that's, one or two of these is going to return multiples of the fund, where you're going to get capped out at either 10 million or 10x the original investment.
Yeah, that's a really good point to bring up as well in terms of it capping out. But that 10 million, that is on correct me if I'm wrong, but that's on an individual level, right? So even if a venture capital fund does 100 investments, and two of them 50x and return 200 million to the fund, unless the individual investor is getting more than 10 million, they'll still be able to write off the full amount. Is that correct?
Yeah, this is the debate, where is venture capital an asset class or a fee structure? Because the fund really is just a pass through. These early stage equity investments will work the same for every investor. One other takeaway that I think every potential investor should be willing to ask whoever they're going to park their money with is that advisor or that fund manager, how they invest their own money. It is a little bit more common on the fund manager level, and a lot of these general partnerships will require the employees and the managers to put in some portion of their capital. But I think it is a very fair question to ask other people how they invest their money. So, John, are you willing to? I know you said 10 to 15.
Yeah, absolutely. No, I love that. I think it is important. And personally, Spencer and I have a policy with OneFund that every opportunity that goes on the platform, we put our own money into. Specifically because, number one, I think practice what you preach. If you believe that private equity and venture capital are an important part of a portfolio, you need to be invested in it. But also, we actually have written into our documents that we will put in a certain percentage of the capital that goes into the fund. And that's also something in the diligence process that we look for when we're looking at funds. We're looking to see, are the people running these funds putting a meaningful amount of money of their own capital into it? And I can't speak for my co-founder, but I at least am targeting that 15 to 20% of my assets in private equity in one form or another, venture, growth, or buyout. And my reason for that personally is tracking what top institutions and endowments are doing. And what you typically see is that they put, like I said, about 15 to 20% of their assets into alternatives. And so that's what we're trying to do over here. Chris, I don't know if you're, and the rest of my portfolio is in very, very, very diversified public equities. I'm a huge proponent when it comes to public markets of the efficient market hypothesis and just trying to be as diversified as you possibly can. Chris, I don't know. I'd love to flip the question back to you and kind of get your thoughts on how you allocate.
Yeah, so I start with my income first because it can act like a flywheel. Most of my income is derived on stock market performance, just the traditional advisor model. If you manage X amount of dollars and collect 1% on it, if the market goes up 10%, then you're getting a raise. But if it goes down, you're going to take a bit of a haircut there as well. So being as mindful of that as possible, I want to diversify my investments away from my income source. So I'm looking to get a lot more allocation to private market investments. And the thing that's slowing me down the most there is the drawdown schedules. So this is another thing that I think a lot of investors have a hard time fully grasping. When you make an allocation of, say, $100,000, a round number, generally speaking, you're only putting 20 to 30% of that in the first year. And that last allocation isn't made until year 3, 4, or potentially even later. So doing that income planning on the front end is a lot of work to make sure that you're not overextending yourself. You have plenty of liquidity in your other investments. And I'm with you. I have a globally diversified value tilt to my public equity portfolio. That's the default where all the cash goes in. Life happens. We're doing a huge renovation. So overweight cash at the moment, that hurts knowing how well other investments are performing. But then slowly pushing things more and more to privates because of that illiquidity premium. I don't need help not touching the money, but glad that it's there and earning higher rate of returns over time.
And I think that thinking about what that drawdown period looks like, it's called a capital call, which is actually the name of our newsletter, is really important in terms of just understanding the investment and when you're going to need to put the money forward. So, I noticed we have a little bit of time left. I'm going to just quickly launch a poll. So feel free to vote. If there's just anything that you'd like us to double click on, feel free to let us know here. If there is nothing, don't worry about it. We have a few questions that came through. And so maybe in the meantime, while people are voting on that, Chris, I'll just say, so there were a couple questions that came through in terms of, there was one for what types of PE funds typically qualify for QSBS. And I think, we already talked about that a little bit. It's mostly in the venture space. And then there was also a question around, can we talk through manager selection a little bit in terms of how you think about what managers to look at, and in particular, past performance. I'd love to get your take on past performance, especially, you spend a lot more of your time thinking about public markets as well, and what kind of weight or stock you put into it there. But at least when it comes to private markets, there's a lot of different components that you're looking at. You're looking at not just past performance. Past performance is really important. And I think there's actually a chart in the appendix of the slideshow that I can share that talks about that a little bit. But you want to look at past performance. You want to look at the team that's running the fund, understand what their experience is and what they've done historically. And you don't just want to know kind of like who they are and what they've done, but you actually want to, one thing that we do when we're going through deals is we do something called deal attribution. So when we're looking at a potential fund that we might consider putting on a platform, we'll often go through and look at the different deals that have been made by that fund historically, and we'll say, okay, who was active in those deals? Like, who led those deals? Are the people who led the deals that have performed really well historically, are those people still at the fund, or have they left? A fund may have really, really great performance in its historical, predecessor funds, But if it was all done by a rainmaker who since left, that's something that you want to be aware of, right? We also want to get a sense of the thesis and the strategy of the fund. If a fund has performed really well historically, but they're changing their strategy, that might be a little bit of a red flag that you want to dive in there. You know, what you'd like to see is that they're following a strategy that's gone really well. They have a consistent team, and they're kind of rolling out that strategy. Again, just because that gives you a bit more confidence in, hey, they've done this before. And so that's all quite important. And there's actually, I've just found it, but there is a really good slide on this. Let's see, I'll share my screen. But this is some data from PitchBook, and it goes over the correlation between what quartile you're in for your predecessor fund and what quartile you're in for your successor fund. And so the way to read this is, a predecessor fund is, private equity funds. They might do a fund one, a fund two, a fund three, a fund four, and you may invest in fund four, a fund that they're raising for right now. What this does is it takes a look at, okay, what is the correlation between how well a fund's previous funds have performed and how well its future funds have ended up performing. And so this is looking at private equity and venture capital. And so what's quite interesting is that there is a correlation here. You see that on the private equity side, 34% of funds whose predecessor funds were in the top quartile have their successor funds also in the top quartile. But it's not a given. Just because you're in the top quartile, 17% of those funds ended up in the bottom quartile on their next fund. And only, roughly 70% of funds that had a top quartile predecessor fund, only 70% of them were even in the top half for their next fund. So 30% were below. And so this is a good correlation, right? It gives you something to build on. It gives you some confidence of, okay, there is a correlation here, but it's not everything. Like I said before, you also want to think about team. You want to think about the strategy. You want to think about the management company itself. You want to think about their brand, which can be really, really important. The SEC has a very strong stance on this, and it's that past performance is no guarantee or no indication of future results. And this chart is part of the reason why, right? Just because somebody was in the top quartile before doesn't mean they'll be in the top quartile going forward. But the data does definitely show that there is a bit of a correlation. There is a bit of a trend that you want to pay attention to, especially when it comes to the bottom quartile. Bottom quartile funds, that is the strongest correlation of if you're bottom quartile in your predecessor funds, you are 41% of the time, they ended up having a bottom quartile fund in their successor funds. So that's just a little bit of, I guess, the importance of correlation when we think about manager selection, but part of the reason why it's not everything. And so I will close the poll. It looks like the two top topics were manager selection and operating teams. So I will. We just chatted a bit about manager selection. I'm actually thrilled that operating teams is what people wanted to discuss. And that's because in my prior career at General Atlantic, I was on their operating team. So this is something that I am very familiar with. And I've been hoping that in these webinars, people would want to deep dive on that at some point. So if you think about how a private equity fund can add value, they can add value through financial engineering, like leverage, multiple expansion. So basically increasing the price that they're going to sell the asset for down the line. But another way that they can add value to the companies that they invest in is through their operating teams. And this is one of the advantages that private equity funds have over public markets, is that they actually have these teams that they bring in they often have these teams that they bring in to help improve their portfolio companies. And so there's a few different models for how this could look, but there's the operating partner model, which is typically less integrated in with the portfolio companies. You might have sort of like the gray-haired former CEO who's very experienced, and they'll kind of work as an advisor for the portfolio company. So say, Warburg Pincus goes out and makes an investment in an auto parts manufacturer. They may bring in a former CEO from another auto parts manufacturer, or from a car manufacturer or a distributor or a shipper, to come in and basically have like sit down meetings with the C-suite and give them um, really detailed advice in terms of how the industry works, how they should think about pursuing certain opportunities, and that can be really valuable. Um, on a slightly more integrated level, you might have firms that have their own internal consulting teams dedicated to helping their portfolio companies. So with that, you can think KKR, Vista have these models. So KKR, for example, one of the most famous private equity companies in the world, and if anybody here hasn't read the book Barbarians at the Gate, I highly recommend it. It's a classic. Um, but they'll go in and will bring in a whole team of consultants that work just for KKR to embed with their portfolio companies and help them on these really strategic problems. And then on the far right, you have firms that take a more integrated operating team approach. And this was the team that I worked on while I was at General Atlantic. But OpenView, General Atlantic, Insight all have teams that work for the private equity company, and their job is to run consulting like projects for the companies that they work with, for the companies that they're invested in. And the main goal being to help generate top line growth, maybe help them get more insights into data analytics or supply chain. But this is a topic that I really love. It can be a huge value driver. I saw it firsthand during my time at General Atlantic. And this is something that we look for additionally when we're diligencing funds. Does a fund have a team like this? Is it appropriately sized? Are they using that team to actually help generate value for their portfolio companies? Because this can be a really huge lever for LPs who are invested into private equity funds. When you invest in a company on the New York Stock Exchange, the New York Stock Exchange is not sending a team of dedicated consultants or former CEOs to go help the publicly traded companies figure things out. So one thing we look for when we're diligencing private equity companies is to see if they have a team or if they have a program like this that they can use to help drive value for the company. Chris, we do have one question that just came through on the tax side that I wanted to throw out, and then I think we can wrap things up. But someone wrote in and asked, what are the pros and cons from a tax perspective of investing in a fund as an individual versus as an entity? I don't know if you have any thoughts on this. I have, one or two thoughts that quickly jump to mind, but I'm curious what your take is.
Yeah, two just quick ideas. It really depends on the entity. So likely if we're talking about an LLC, that's just going to pass through to you individually regardless. The other aspect to consider is the estate planning. So if you want this out of your name into your estate, and if you're talking about the entity being some sort of trust, that could change things as well.
Yeah, one thing that I'd say is, entities can be really helpful from a tax perspective, but I also think that people often think that they do more than they actually do. Entities can be really helpful from a liability protection standpoint, but sometimes entities can lead to you being taxed more. Like in Chris's example of a C corporation. One way that I've seen a lot of people invest in OneFund, for example, through entities that's been successful for them, is setting up entities to invest as an RIA. And so investing via an RIA or a 401k can have really significant tax benefits. Typically, you're only, depending on if it's Roth or not, you're either being taxed only once upfront on your income and then not on your distributions, or just on your distributions down the line. And so I'm not a tax expert by any stretch of the imagination, but that's one really popular way that we've seen investors come in to OneFund through entities in order to limit their tax liability down the line.
Self-directed IRAs, yeah, great tool.
Yeah, they're a fantastic tool. And thank you once again to everybody who joined. It was really great talking with you all and talking with Chris and answering some of your questions that came through. We really appreciated it. And we're recording this, and so we'll make sure to share a recording shortly soon in case you want to reference it for anything.
Thanks, John.
All right. Thank you, Chris. Thank you, everyone who joined. Bye-bye.